Welcome back to the Deep Dive. For years, the whole conversation around wealth has been, dominated by performance. We talk about what assets you hold, equities, bonds, property. But today, we are shifting the focus entirely. We're looking at the architecture of wealth. We're talking about that critical, often overlooked structure, the protective shell around your assets. We are deep diving into investment wrappers.
And it's probably the single most crucial area of financial planning. It really is. Because the wrapper is the structure that ultimately defines how efficient your investment is going to be. So our mission today is to understand the strategic why behind them. I mean, the core surprising thing from the sources is this. You can have two clients holding identical underlying investments, the same global equity fund, same risk profile, everything. But their final outcomes, their net wealth, their tax bills, their access to the money can be radically different. And it's all because of the wrapper they chose.
That's a profound distinction. It means all the work you put into choosing the right fund could be, undermined if you put it into the wrong box. Okay, let's unpack this. The structure, that's the shortcut to efficient wealth growth.
Exactly. And we should start with the most fundamental point. A wrapper is not an investment. It's just the legal vehicle that holds it. And it dictates, really, three things. The tax treatment, how easily you can get to it, and how it's managed. It's like a set of rules you layer on top of the assets.
Okay, and to make that really clear, let's use an example, the baseline. Let's say I've got 20,000 pounds in a high-growth index fund. Scenario one, it's inside a tax-advantaged wrapper, like an ISA. What happens to my return in 10 years?
It's protected. Every single pound of profit, whether that's capital growth or income from dividends, it's all completely shielded from income tax and capital gains tax. Now, you take that exact same fund, same 10 years, but you put it inside a general investment account, a GIA. Sometimes we call it an unwrapped account. All those returns are now exposed to annual taxation. And that contrast, that right there, is the driver of almost every wealth structuring decision.
So let's focus on that baseline then. The general investment account, the GIA, the default option with no armor.
Yeah.
What are the key details an investor needs to know?
The GIA is very straightforward. Its main pros are simplicity and complete flexibility. There are no government limits on how much you can put in, and there are zero restrictions on access. You can sell everything tomorrow if you need the cash. The downside, though, is significant tax friction. All your income dividends, it's taxable at your income tax rate. And any gains you realize are subject to capital gains tax.
But hold on, surely the GIA isn't that bad, especially if you're smart about using your annual capital gains tax allowance. I mean, that's what it's there for, right? To shield small profits.
That's a critical point, and you're absolutely right. That CGT allowance is a huge advantage, and everyone should be using it strategically. But the GIA still creates a management headache. Even if you use your allowance every year, you're creating this annual administrative task. And more importantly, the GIA can't shield your income, the dividends and interest. They suffer that tax drag year after year, whether you sell anything or not.
So it's not just the big tax bill at the end. It's a constant small leakage of income tax that just compounds against you over decades.
Precisely. That tax drag is why the GIA is nearly always a secondary solution. Advisors will typically only recommend it once a client has completely maxed out their allowances in the more tax-efficient wrappers, or, if they need absolute unrestricted access to a very large sum of money.
Okay, this is where it gets really interesting. Comparing the tax-efficient giants, ISAs versus pensions. These are the two most popular UK wrappers, and the trade-offs are just essential to understand.
They serve two very different masters. ISAs, individual savings accounts, they're widely loved for a reason. They protect all your growth, all your income, and all your withdrawals from tax. They're simple, flexible, efficient. They are just excellent for medium-term goals or even long-term ones where you might need access before retirement.
And the limitation is just that annual contribution limit. You use it or you lose it each year. But the big draw is that flexibility. Withdrawals are tax-free at any time.
That accessibility is the key difference from a pension. The trade-off, though, for that access and tax-free withdrawal is you don't get tax relief on the money you put in. You're investing money that has already been taxed.
Which brings us to pensions, often the most powerful tool because they completely flip that tax equation around. They're all about upfront tax relief.
They are, and it is incredibly powerful, especially if you're a higher or additional rate taxpayer. You get tax relief on contributions, so your savings are grossed up from day one. You get tax-efficient growth, and the death benefits are usually treated very favorably. They are the absolute cornerstone of retirement planning, and they encourage discipline because the money is locked away.
But if we connect this to the bigger picture, given how valuable that tax relief is, doesn't that make pensions the most vulnerable wrapper?
Yeah,
to future political changes? I mean, things like access age or what tax rates will be in the future.
That is a very important question, and it's a valid concern. Any tax advantage scheme has political risk, and because the relief is so generous, there's always a chance of rule changes down the line. So the advisor's role is a real balancing act. You're trying to maximize that powerful tax efficiency while making the client fully aware of the restrictions on liquidity and that long-term legislative risk. It's a powerful tool, but it is a restricted one.
So it really comes down to sequencing, doesn't it? As an investor, do I max out my ISA first for flexibility or my pension for the tax relief?
That's the exact question. It depends entirely on your cash flow and your life stage. Generally, if your employer offers a contribution match for your pension, that's the undisputed first priority. It's free money. After that, a younger client often prioritizes the ISA. They need that flexible capital for a house deposit or a career break. It's really only a high earner, well-established, with short-term needs covered, who might prioritize pension contributions over the ISA limit, chasing that upfront relief. So moving beyond the main three GIA, ISA, pension, we get into a more specialized complex category, investment bonds. These are for specific, often high net worth scenarios.
These sound a little bit more esoteric. How do they fit into this strategy?
They're long-term insurance-based contracts. They have very specific tax rules, and you'll hear about onshore and offshore bonds. They aren't for everyone because they are complex, but they offer some really crucial tax smoothing capabilities.
So what's the key difference between onshore and offshore, just from a tax mechanics perspective?
The difference is where the tax is first paid. An onshore bond pays tax internally. So the fund manager pays tax on the income and gains within the fund, which basically acts like the fund has already paid basic rate income tax. This is crucial. When the client pulls the money out, if they're a basic rate taxpayer, there's no more tax to pay. Higher rate taxpayers just pay the difference.
So the onshore bond basically guarantees the basic rate is always paid. It's less attractive than an ISA maybe, but predictable.
Exactly. The offshore bond, on the other hand, allows for tax-deferred growth. The fund grows completely gross, no tax drag inside the fund at all. The client only pays tax when they take a gain or cash the whole thing in. And that tax deferral, that's the key planning advantage.
And what about the withdrawal rules? The sources mentioned a 5% allowance. How did that help with planning?
Yes. That's a powerful feature. Clients can take out up to 5% of their original investment costs each year, and that can roll over for up to 20 years without creating an immediate tax bill. It's treated as a return of your capital, not as income. So the tax payment is deferred until 20 years are up or the bond is fully encashed. This allows a high earner to defer realizing a taxable gain until a time when their income tax rate is much lower, like in retirement.
That ability to smooth income and delay tax for 2 decades, that's clearly the draw. But it sounds complex. It really underscores the need for expert advice.
Absolutely. The calculations for these chargeable events, they're not simple. You have to ensure the client understands the future deferred tax liability.
Now that we've covered the outer layer, the wrappers, we need to talk about the inner layer, the collective investments, the actual products that sit inside the wrapper.
These are the essential building blocks, yes. We're talking about unit trusts, OEICs, exchange-traded funds or ETFs, and investment trusts. They're all just pooled investments that give you diversification and professional management.
For our deep dive audience, we should probably touch on the structural differences, because they can dictate things like liquidity and cost. What's the main difference between, say, an OEIC and an investment trust?
The core difference is their structure. OEICs and unit trusts are open-ended. When you invest, the manager creates new units for you. When you sell, they cancel them. This means the price is directly linked to the value of the underlying assets, but it can also force the manager to hold cash to meet redemptions, especially when markets are falling.
Investment trusts.
They're closed-ended. They're just companies listed on the stock market, so there's a fixed number of shares. You buy and sell those shares with other investors, not the fund itself. This means the share price can trade at a premium or a discount to the asset value. And it also allows the manager to use gearing or leverage, which is a key strategic difference for someone with a higher risk appetite.
And that creates the layered approach we've been talking about, the right fund choice within the right wrapper choice, optimizing both the engine and the chassis.
And if we connect this to the bigger picture, choosing that right combination, it relies entirely on matching the features to the client's needs. Suitability, which requires rigorous filtering. And this raises an important question. What do you think is the most challenging filter for clients to really grasp?
For me, it has to be cost. Filter 1. Clients see a 1% management fee, and they think, that's small. But they fail to model the absolutely devastating impact of compounding cost over 30 years.
It's the insidious hidden killer, you're right. Cost transparency is everything. Charges vary by wrapper, by product, by platform. An advisor has to make sure every basis point of charge is justifiable. We know for a fact that higher costs directly reduce returns. A difference of just 0.5% in fees can cost a client tens, even hundreds of thousands of pounds over a lifetime.
Okay, filter two, based on what we've said about pensions and bonds, has to be liquidity and access. You just cannot plan for a medium-term goal if the cash is locked up.
That's the crux of it. Matching product liquidity to the client's need. A client saving for a house deposit in 5 years needs an ISA. Highly liquid. We have to be brutally honest about illiquidity. Pensions lock money away for decades. And some funds, like property funds, can suspend withdrawals completely during market stress. Suitability demands we balance that growth potential with the real-world need to actually get to the money.
And finally, the whole purpose of this exercise. Filter 3, the tax strategy. This is where the GIA, ISA, pension, and bond all sit on a different point of the spectrum.
This is the navigational challenge. The entire process hinges on knowing the tax status of each wrapper. So, to recap, the ISA offers complete protection on the way out. The pension offers tax relief on the way in. The unwrapped GIA means annual tax liabilities, and the investment bond allows for strategic tax deferral.
So the critical responsibility for the planner is helping clients align these different wrappers with their specific situation: income tax, capital gains, and also, crucially, inheritance tax.
Exactly. For IHT, pensions are usually outside the estate, very attractive for older clients. Investment bonds can be placed into trust. This holistic tax mapping is what separates, basic product selling from genuine wealth management.
So what does this all mean for the long-term investor? It's clear wealth management isn't static. The wrapper strategy has to evolve over a client's life.
It absolutely has to. We see 3 broad phases. Younger clients, they prioritize ISAs for that flexibility, maxing out their allowance while saving for medium-term goals.
And then phase 2, the mid-career high earner.
They're focused heavily on pension maximization, capturing that powerful tax relief. They might even use investment bonds if they've maxed out all their allowances. They're sacrificing short-term flexibility for long-term compounding efficiency.
And the final phase, drawing down in retirement.
The strategy completely flips. Retirees then strategically draw from specific wrappers to reduce their overall tax bill. They might take tax-free cash from their pension, use their tax-free ISA withdrawals, maybe use their GIA and their CGT allowance, all before dipping into the fully taxable part of their pension, minimizing that income tax drag in retirement.
It's a dynamic, layered, and optimized approach. The wrapper defines control, tax, cost, and suitability. The job isn't just to pick good investments, it's to make sure they're held efficiently. So the key takeaway is clear. You're not just investing, you're organizing your wealth efficiently. And the wrapper is that organizing principle. It's what decides if you pay tax on your growth and when.
And we'll leave you with this final thought to explore. Given the exponential power of tax relief and compounding over decades, consider whether strategically managing the progression and adjustment of your different wrappers throughout your entire life is maybe even more critical to your final net wealth than any single stock-picking decision you might make today.